Friends, welcome to our today's session. This session will be starting our last unit, that is Unit 5. It deals with short-term asset management. So you might be aware of, and by this time you must be knowing all these things that when you do business, you make some investment in long-term assets, that means capital assets. And some investments are also made in short-term assets. Short-term assets means current assets, what we call. That includes, let us say, raw material, finished goods, all these things are required to be invested in a business. Why they are short-term assets? Because their life is short. Within the operating cycle, they changes. So these short-term assets are in fact a part of working capital. When you say short-term asset management, what exactly we are referring to? We're referring to working capital management. So in any business, we have some long-term capital as well as short-term capital. Okay. So if you look at the syllabus, it talks about strategic planning for estimation of short-term funding. That means if you want to have some working capital, how you are going to fund it? What is the strategic planning for that? Okay. And definitely there is a need. So we'll be discussing about the funding needs and financing sources, computation of short-term fund, all these things we are going to learn. So if you look at your screen, which I'll be sharing the slide right now. So slide, if you see, it is talking about management of working capital. That means exactly I'm talking about management of short-term assets. Okay. So some basic understanding you have to see. Working capital, when you say, it is the capital which is required for day-to-day operation of the business. If you want to run a business, you need to have some assets. Okay. And you'll be also having some liabilities. For example, if you want to run the business, you should have some stock. You need to maintain some stock. Okay. And you might have sold some of these stocks to your customers on credit. That means that something is receivable. Okay. That is also your asset. They are your sundry debtors. They are also your assets. And it is expected that the receivables will be recovered within the operating cycle. That in short run, that will be recovered. Right time you are making investment in this recovery, these receivables. And when you are keeping stock in your shop or in your factories, you have to keep some stock, maybe 15 days stock, maybe 30 days stock you have to keep, so that a person who is visiting the shop, he should look at the stock and he should decide what to buy. Some investment has to be made in this kind of stocks. So they are, in fact, current assets. And so you need funds to be invested in this kind of current assets. But at the same time, you also imagine that suppose some of this raw material or some of these stocks you are able to get in credit. When you are getting in credit, that means actually you don't need funds right now to buy that stock. But you have a liability. So how much money you require? Let us say you want to keep some stock. But some of the stock, you want to keep some stock worth 1 lakh rupees. So in your shop, there should be stock of goods worth 1 lakh rupees. But out of which 40,000 worth stock you can get on credit. That means to keep 1 lakh stock, you need only 60,000. If you're having 60,000 cash, you can pay to your supplier. 40,000 you can get credit and you can keep the stock. Then the 40,000, since you are getting goods worth 40,000 on credit, there is a current liability. So the net amount that you require is the value of current asset minus current liability. The net amount is required to be invested in the business. So in this example, what is required is 1 lakh rupees minus 40 lakh rupees current liability, 60,000 rupees is required. Okay. So another way of understanding working capital is it is the excess current assets over current liabilities. Right. And if you analyze, if you look at the concepts of working capital management or short-term asset management, first there is a one way is that look at the value aspect of it. Other way is that look at the time aspect of it. If you look at the value aspect, there is a concept called as a gross working capital. Gross working capital means actually the current asset, the value of current assets refers to as the gross working capital. But as you know, some of these current assets can be financed or credit. So if from current asset, if I deduct current liabilities, I'll be getting a figure that is called as net working capital. You may look at the balance sheet of an entity and find out how much is the current asset, how much is the current liabilities. The net amount of that is the net working capital. And the only current asset refers to the gross working capital. Right? As I told you, there is another way of analyzing working capital, that is permanent working capital and temporary working capital. Permanent working capital means a part of the working capital is permanently needed. In the long run, you need that. And temporary working capital means uncertain period, uncertain days, you might be requiring some extra working capital. For example, you are going to pay salary on 7th day. On 7th day, you need some extra cash. That's not your permanent capital, but on that date, you need some extra tax, extra cash. Or you want to pay the advance tax in the end of a quarter. You need some extra fund on those days. You can imagine something like this. Suppose daily you are going to your college and you need 20 rupees in your pocket to meet your traveling expenditure, etc. Let's say daily you need 20 rupees only. So that is your working capital. At any point of time, you should have 20 rupees so that your day-to-day requirement can be met. But on certain days, let us say on some day there is an examination. You may like to give 50 rupees instead of 20 rupees because you thought in case something happens, instead of bus, you might take an auto. You may travel by auto. So you need some extra. So in some few days, you need some additional capital. That is your temporary working capital. But permanent working capital is 20 rupees, but the temporary working capital is 30 rupees. That is excess of this permanent working capital, what you require, that is your temporary working capital. Look at this example. It is talking about how you will be able to calculate working capital. Simply find out the current assets, deduct current liabilities, you'll be getting working capital. Current assets include cash, account receivable, that is sundry debtors, inventories. Current liabilities includes accounts payable, short-term borrowings, accrued liabilities. So in this example, 80,000 is the current asset and 40,000 is the current liabilities. Consequently, working capital is the 40,000. Look at this example, you'll be able to understand. Okay, what is current asset? Okay, what is current asset? Any asset which can be liquidated within the operating cycle is the current asset. Okay, and if you see the technical definition, Companies Act defines current asset. You see, this is the definition. An asset can be classified as current when it satisfies any of the following criteria. One, it is expected to be realized within operating cycle, or it is intended for sale, or it is held for trading, that is a stock in trade, or it is expected to be realized within 12 months, that is considered to be short term, or it is cash and cash equivalent. All these things are the examples of current assets. Okay. Normally in business, what happens? If you look at this picture, it talks about operating cycle. So one businessman starts business with cash. He purchases some raw material. And raw material is converted into finished goods. And in the process, there will be some material which is called as the work in progress. That means there are semi-finished goods. And finished goods will be sold. When it will be sold on credit, it will be converted into debtors. And debtors will be paying you cash. This happens in the business. This is called as the cash to cash cycle. The assets which are involved in this cycle are referred to as current assets. Okay. So these are the examples of current assets: inventories, receivables, cash and cash equivalents, prepaid expenses. Similarly, current liabilities, if you look at the definition, these are the liabilities which are expected to be settled within the company's normal operating cycle. means normal operating cycle. That means operating cycle you have understood. Someone starting from cash, then converting into raw material. The raw material is converted into finished goods, semi-finished goods. Then it is sold. Then finally cash is realized. Suppose it takes 2 months. 2 months the operating cycle. Suppose it takes 6 months. 6 months the operating cycle. Suppose it takes 3 hours. 3 hours the operating cycle. Okay. So these are the assets which are primarily held for the purpose of being traded, like stock, or for trading purpose itself. These current liabilities are likely to be settled within the period of 12 months, right? And the company doesn't have an unconditional right or debt settlement of the liability at least for 12 months. That means company has no right to defer the settlement. It has to be settled within short term. Then it is a current liability. Okay, so this is what I've understood current asset and current liabilities. This is again the examples of current liabilities, trade payables, short-term borrowings, and outstanding expenses. Suppose electricity bill has come but you have not paid. It's a short-term liability. You have to pay. So this is an example of current liabilities. Okay. Now if you look at, you have already understood the concept of gross working capital, net working capital, current liabilities, current assets you have understood. The difference is the net working. Now look at here this picture, or I'll show you some other picture. Okay, you see part of the, let us say, fixed element of this talking about that how one should plan the finance or strategic planning as regards to financing of both long-term capital or fixed asset as well as short-term assets. So if you want to do the business, you will be needing some fixed assets first, right? You need plant, machinery, building. So this has to be this fixed asset, the bottom portion. Ideally, it should be arranged through long-term finance because the assets will be used for long term. And working capital, that is short-term finance, short-term money requirement, or short-term assets should be acquired through short-term finance, not long-term finance. However, if you look at the working capital component, as I explained you earlier, it might be having two components. One is the fixed element of the working capital or the permanent part of the working capital. Second, the fluctuating part of the working capital. That in some occasions that amount, when you need that amount, need some additional amount. So this permanent part of the working capital or fixed part of the working capital may be financed through long-term finance. So long-term finance can be arranged both for fixed assets as well as fixed element of working capital. But for short-term element of working capital or fluctuating part of the working capital, short-term finance is better. Business houses should arrange that fund through short-term finance. That should be the strategy. I think you've understood. So fixed assets definitely long-term finance. Then fixed element of working capital, one may opt for long-term finance. And fluctuating element of working capital, one should go for short-term finance. This should be strategy for financing your working capital. Now coming to estimation part of the working capital. And here, look at this chart. In this previous chart, or that means in this chart, the requirement of fixed asset or fixed asset element of working capital is straight line, that is, it's fixed. But here it is estimated that over a period of time, the permanent part of the working capital will be more and more. That means with passage of time, you will be needing more permanent working capital. Okay, it doesn't matter. The permanent part has to be arranged through long-term finance, and the temporary part should be arranged through short-term finance. Okay. Now let us see, and what may be the sources. I'll be talking about the sources. Now we'll be talking about estimation of working capital. Just give me a second. I'll be looking about the estimation, how working capital can be estimated. You see, this is various methods of estimating working capital. Working capital again refers to short-term time. First is operating cycle method or current asset holding period. Here, what happens, we find out that if you have to keep some current asset, let us say raw material, for how many days you have to keep that raw. Debtors, how many days the debtors has to maintain. Semi-finished goods, how many days it has to keep. And what is the value of that raw material? Okay. So by using this operating cycle, we'll be able to estimate what is the working capital requirement. Second way is that ratio of sales. Here what happens, we try to find out, or we assume that current assets change with changes with sales. That means if this last year, this was the sales, this was my working capital or current assets. Current year sales is expected to be double, then my current asset requirement is double. This is how we estimate. Third is ratio of investment mode. So it is estimated that the short-term assets or short-term finance is a percentage of fixed investment. So if my fixed investment, it let us say 1 lakh, and working capital or long short-term finance is 20,000, it is 20%. Next year, if the fixed asset grows from 1 lakh to 1,20,000, then we should also maintain 20% working capital. That means instead of 20,000, I need 24,000. Okay, so these are the three popular methods of estimating work. Okay, so we have understood the methods of estimation of working capital. Now, friends, we'll do one thing. We'll stop here. We'll stop here today. Next class, we'll be catching up with some other issue, that is financing sources, then cost of short-term funds. These two things will be covering in our next session. Thank you.